Good afternoon. Welcome to Midcap Radar. I'm Reema Tendulkar. With me is Ekta Batra, and these are the top stories that we're tracking this afternoon. Stocks slide across the globe on high interest rate worries. The Silicon Valley lender SVB Financial reports losses on its bond portfolio. The Nifty holds 17,400, even as the midcaps fare better than the headline indices. Most sectors flash red.
Ajanta Pharma slides after the board approves an over 300 crore rupee buyback, its third in several years.
Electra Green Tech and JBM Auto gain for the second straight day on Maharashtra SEV push. The state announces the expansion of its EV fleet.
Equitas Small Finance Bank falls 6% in trade as its reverse merger with Equitas Holdings gets completed and shareholders are allotted Equitas SFB shares for trading starting today.
When it comes to the markets, it's clearly a down day. Markets are worried. The benchmark indices are down 1%. Nifty hovering around 17,400. Pull up the intraday chart and you would see that volatility took place in the first 1 hour. The Nifty went down to levels of 17,350 after a gap down opening. After that, it saw a bit of a recovery, but in the last 3 hours, from 10:30 a.m. to now, the markets have been hovering around that pivot level of 17,400. Key indices down 1%. The banks are underperforming. What's the way forward? Dharmesh Shah of ICICI Direct is now with us on the show. Dharmesh, down 1% on the Nifty. Earlier this week, we were hoping for a breakout on the way up, markets pushing higher, but things have turned.
Yes, I think so. We still remains to be in that trading range. You see, Reema, we have been trading in this range of 17,200 to 17,800 for last 2 to 3 weeks, and we believe, I think so. Today there is an important data from the US tonight, and next week also you have CPI inflation data which is expected to come. In all this process, if we manage to hold 17,200, which we expect to hold, we will see a technical pullback in the coming week. So we believe, I think so, market, yes, on the back of global sell-off, we are seeing a gap down opening. But we believe 17,200 remains to be the very strong support, which we expect to hold. And maybe I think there's some bit of a positivity from the US market tonight or maybe on the coming week should see a sharp spike in our Indian market. So we believe, I think so, 17,200 to 17,800 is likely the range for the Nifty, which we expect to hold in the coming week.
Okay, well, we've got the Feb mutual fund data, which is on your screen, and there is a 26% rise that we've seen in terms of equity inflows this month as well. So it's coming at around, net equity inflows have come in at around 15,657 crores, which compares to around 12,472 crores. So it's an over 20% rise on a month-on-month basis. The other segments, such as the hybrid flow, has come down. We have the liquid fund outflow, which has risen to around 11,304 crores versus 5,041 crores. And the total debt scheme outflow has also risen on a month-on-month basis. So those are more of the fineries. Even the ETF outflows or the ETF inflows have fallen quite significantly. So maybe that should come up for you. But the big headline number is that people continue to invest into the equity market. So there's really been no deterrent despite all what we've seen globally, as well as what has happened with Adani stocks in terms of the risk sentiment for the markets. So the net equity inflow continues to be strong, 15,657 odd crores for the month of Feb as compared to 12,472 odd crores in the month of January. So more details on your screen. The large cap fund inflow has reduced. It's almost half, 354 crores to around versus 716 odd crores. And the other details should come by on your screen as well. Dharmesh, in terms of a couple of stocks which you would probably take in as a technical strategy into next week, which is probably showing strength, what would it be and what would you recommend?
Yes, so technically we remain to be positive for the PSU space, where it's clearly showing the outperformance even in this falling market. So Hindustan Aeronautics among the defense space remains to be a top pick. If you look technically, I think so the stock has witnessed a breakout of last 3 months trading range, which was in the range of 2,300 to 2,800. The breakout too has witnessed with a strong volume. One more point to highlight on the key highlight is that the stock also has witnessed a faster retracement, where the 10 weeks of declines getting retraced in just 4 weeks. So clearly showing a robust price structure technically. We expect stock to head towards 30 to 40, keeping a stop loss of 25.80. So HL remains to be a top pick inside the defense space. Apart from HL, power space also is one which is clearly showing the resilience. If you look at the most of the power stocks, they are back in limelight after long consolidation. So Tata Power among the power space remains to be a top pick, where if you look on the weekly chart, the stock last 2 months has been forming a very strong base in the range of 190 to 210. We see, I think so, breakout of a falling channel. It is near the cups of the falling channel breakout. We expect the stock to head towards 224, keeping a stop loss of 198. So Tata Power and HL remains to be a top pick inside the current corrective phase market.
Okay. Thank you very much for joining in. Let's talk a bit about the February mutual fund data. Swaroop Mohanty, Chief Executive Officer, Mirae Asset Investment Managers, is with us on the show. Swaroop, want you to react to two data points. One, the net equity inflow has seen a pickup in the month of February, 15,657, which compares with 12,500 approximately month on month. And the other one is the total assets under management, which has fallen from 39.6 lakh crore in January to 30.5 lakh crore. So it's a sharp decline in the total assets under management. Can you talk a bit about what led to these two data points?
I think the first one I'll talk about is it's so heartening to see, right? You know, I mean, today you call so many experts to the show and you showcase so many people who surround the stock market. But today the actual hero of the stock market, and especially Indian market, lies in the hands of that individual investor who's going on pumping in the SIP number, which is keeping the market intact. And when you see that number going up, you are seeing the beginning of probably the equity culture seeping deeper into the country, and people understanding that volatility is the best friend of the investor through the SIP route, and hence continue to plug in their SIPs month on month. It's a fantastic sight to see, and it's good to see that people realize the power of the asset class. And it's only when you continue to buy in markets like this that your wealth creation opportunities go up, is something which is reflecting in the behavior of investors right now. On the second part, I'm not very sure of the data. Let me check back, because I don't think there is anything that will show that kind of a drop in assets in the industry. I'm not very sure of the data that you're referring to. I'll have to check and get back, because that kind of data drop is not possible, if you ask my personal opinion.
Okay, because the total assets under management historically has been around that 40 lakh crore mark.
And I think it's 39.46 lakh crore.
Okay,
so I think it's just about flattish on a month-on-month basis.
I think the first flash went wrong. There was an error there. So it's flat, right?
It's flat on a month-on-month basis. Swaroop, 9-month high for equity inflows. You've been talking about this whole equity cult. This is despite a lot of disruptions which probably took place in the market, when it came to the Fed indicating that they're going to hike for longer, as well as the Adani Group fiasco which has taken place. If you could just give us a sense in terms of what you expect going forward in terms of net equity inflows, because we're talking about 9-month highs in the month of Feb, where there was volatility in the markets. What is the trajectory that we could expect?
I think we have to really relook everything now. I mean, the whole market sort of predicted that market figures will be terrible this month, but the data which has come out is very contrary to people's belief, and that's where something is a realization of the last 2-3 years, especially post-COVID, that the way people view investing is dramatically changed. Two things: one, of course, COVID has given people a different outlook towards investing, and second, obviously the demography of the country beginning to play out. And when you see the young of India, they're economically very different, and from an information perspective are different. So their risk-taking ability and their approach to investing could become very different, is something we are beginning to see. And when you look at this particular month figure, because it's going to be very significant, and it's something which will probably pull the market for the rest of the year, is that as data points remain weak, that's something which the investor cannot do anything about, because that's a factor of the market. What the investor can do is take control of his or her behavior and the approach to investing, and that's coming out to play. And if they continue doing that, a lot can happen to their overall wealth creation journey, and that's on display right now. So a lot of credit to the investor, a lot of credit to the advisory community and the distribution community to keeping investor not only intact, but showing them the value of the long-term story of India, which is intact and it's looking pretty good post-COVID.
Okay. Swaroop, wanted to get your thoughts in on a story that our colleague Santosh Nair of Money Control broke. And this is what he learned from sources, is that SEBI is proposing that mutual funds need to own their broking or foot the broking expenses. So mutual funds should get membership on stock exchanges and do their trades via their own terminals instead of giving it to an outside brokerage and then, getting the clients or the customers and, get them to pay for that brokerage. Your thoughts on this story? Right now, at least, it's in very early stages. It's only in discussion stages. But if that is to play out, if mutual funds indeed have to do their own broking or foot their broking expenses, how does it change and what are the implications?
I mean, it won't be right for me to talk. I would rather, if that story does play out, that will be in the anvil of Amphi to speak on this part. But see, when our relationship with broking community is very symbiotic. I mean, it works both ways. While the trades go in from our side, there's a fair amount of research which comes from that side. So it's a relationship which works both ways, and one needs to get a little deeper into this story before I start commenting. I'm happy that you say it's too early, so let the story play out, and probably Amphi will be the right place to speak about this rather than me on an individual capacity is
Okay.
very frank confession.
Okay, Swaroop, just getting back to the data, I just wanted to touch upon one particular piece of information or statistic. Large cap fund inflows have reduced quite significantly, 354 crores versus 716 crores. And small cap flows have been steady, which has been above 2,200 crores for the third straight month. And mid cap funds also were at 1,816 crores, and they've been tracking at these levels at least for the past 3 odd months. What is that telling you? That mid caps and small caps are continuing to see that maintained interest, whereas large caps saw downtick.
This is as per the expectation of the narrative around the market. As the returns and the alpha factor sort of diminish, people start hunting returns at the lower market caps. And that is what is evident over the last 6-8 months, as you rightly pointed out. There has been a surge towards the mid and smaller cap side of the market. And that is how market cap investing sort of unfolds as the markets become more transparent and become mature. The hunt for returns then graduates towards the smaller caps. But here's my thing: while people might write off the large cap at this moment, but whenever we are talking about investing in large caps, the other option to large cap becomes the Nifty 50. From a Nifty 50 perspective, one has to keep in mind that today's Nifty 50 is 37% financials, and if you add IT to it, it's almost 40-45% in two sectors. Are people cognizant of the fact that any large cap portfolio will be far more diversified, and hence the risk adjusted profile of that portfolio might be very, very different from the present Nifty 50 at this moment. There is this broad thinking that alpha and return generation of large cap is on the diminish or on the lower end. We contradict that post COVID because we believe that there is a lot of value in the larger companies, and especially post COVID, the larger companies can become larger. It is an advantage, larger balance sheets. But the narrative is not exactly wrong. So some people who push for returns will push for mid and small cap, and that is what is playing out that at this moment. My humble request to everybody doing that is also sort of look at the risks that one is piling on by shifting portfolios there. If one is comfortable with that risk, not an issue at all. If one is doing that in cognizance of the risk, not an issue at all.
And what is your read of the ETF inflow in the month of February at 29 crores versus an outflows of 1,700 crore in the prior month?
I think, the ETF business is more transactional at this moment. It will become buy and hold over a period of time. So in volatile markets, what we are seeing is quite natural. There'll be a fair amount of trading is announced, and that's a factor of that way of investing at this moment. It has to graduate more. You are seeing a lot of money on the index side. That is the target maturity funds playing out. But I'm not surprised with the ETF flows as we see it.
Swaroop, we leave it at that. Thank you very much for joining in. So the net equity inflows continue to be very strong, picking up by about 20-25% on a month-on-month basis. And equity inflows into the mutual funds have gone up for the 24th straight month. For 24th straight month, we have seen inflows into the equity mutual funds. This is a very strong data point. We are awaiting the SIP picture, but up until now, the SIP numbers have been very resilient and the trend has only been rising. Get into a break. As we do that, here is a quick programming note. On the 14th of March, CNBC-TV18 will host what will be India's largest summit on gender parity in Delhi. Women leaders from all walks of life will come together to brainstorm and help take decisive steps to bridge the gender inequality that exists in India and across the world. The event starts at 4:30 p.m. on the 14th of March, and you can catch all the live action right here on CNBC-TV18.
Welcome back. Well, definitely some amount of trepidation in the markets at this point in time. There is some news coming in on Vedanta Resources, where Moody's has downgraded Vedanta Resources ratings to CAA1. As you can see, the stock is reacting. It's down around 3.8%. Remember that the larger context is also that the markets are weak today ahead of the US jobs report, which is expected to come out at around 225,000. That's the expectation. So let's see what it delivers. It'll set the tone in terms of what we can expect from the Fed meeting later on in the month as well. But one stock that I'm tracking today is Ajanta Pharma. That stock should come up for you. The board has approved a buyback of over 300 odd crores, 315 odd crores. The buyback is at a fixed price of 1425 rupees. So that means that the buyback will be via a tender offer. It is a premium to the current market price, which stands at around 1204. Now, the buyback represents around 2.59% of total equity and is around 9.93% of the paid up share capital. Remember that Ajanta Pharma has been in focus. They have done buybacks previously, and the stock is down over around 10 odd percent from its 52-week high. But this week, it had recovered a tad bit, but now up around 2 odd percent or 2 to 3 odd percent on a week-to-date basis. So currently, Ajanta Pharma reacting to the details of its buyback, Rima.
Okay, that's Ajanta Pharma for you. Let's get into a break. On the other side, we'll put the spotlight on Tata Motors because its subsidiary, Tata Technology, has filed a DRHP with the SEBI for an IPO. Welcome back. So after almost 2 decades, a Tata Group firm, Tata Technology, has filed for an IPO. Sonia is here to tell us more about the company. Sonia.
Well, it's a big day for the Tata Group. Tata Motors' wholly owned subsidiary Tata Technologies has filed a DRHP with the SEBI for an IPO. Now, this is important because this will be the first IPO from the Tata Group stable after 19 long years. The last one was way back in 2004 when TCS came out with its IPO. It also assumes importance as this is the first IPO from Tata Group under the tenure of N. Chandra, who took over in 2017. Now, Tata Technologies plans to sell up to 9.5 crore shares, which is a little under 24% of its paid-up share capital. Let's talk a little bit about Tata Technologies itself. It's the IT services arm of Tata Motors, catering to Jaguar Land Rover and Tata Motors products. The company provides a range of services, including IT consultancy, SAP implementation and maintenance, and design consultancy, and has a very strong financial track record. Now, the FY22 revenue growth was the strongest ever at 46% year-on-year. And even if you look at the 9 months of FY23, the revenues of Tata Technologies grew about 15%, profits were up 23%. And if you map the margin profile over the last many years, you'll notice that the adjusted margins have increased from 16.5% in FY20 all the way to 19.2% in 9 months of FY23. But what about Tata Motors shareholders? How do they benefit? The monetization of stake in Tata Technologies, of course, is a positive for Tata Motors. But the Tata Tech IPO, along with the receipts of consideration of the EV deal that Tata Motors did with TPG, will help reduce the company's debt. Tata Motors is now well on track to achieve zero debt on its India business versus about 12,000 crores debt as on December 2022. And with this IPO, we will now have 3 listed Tata Group IT companies, TCS, Tata Elxsi, and now Tata Technologies. What are brokerages saying? Motilal Oswal put out a note where they said that they value about 25 to 47 rupees a share in Tata Motors for its stake in Tata Technologies. Back to you.
Okay, all right, Sonia, thanks very much for that. So it is the first IPO from the Tata stable in at least close to 2 decades, something that we can look forward to this year. But nonetheless, for the market still weak, the Bank Nifty down close to around 2%, the Midcap's down over 300 odd points. That's all the time that we have on Midcap Radar. Your stocks once we're back.